Welcome, everybody, to this webinar, which is organized by the Forest and Finance Coalition, in which we will be presenting the key findings of the Banking on Biodiversity Collapse report, which was published at the end of last year. We will be recording this webinar, and we will share the link with all participants afterwards, and it will also be available on our YouTube channel. I am Meryl Vandermark. I'm the coordinator of the Forest and Finance Coalition, and I'll be moderating today. Afterwards, after me, Bart will be presenting the key findings of the financial flow assessment. Then Jan Willem will present the key findings of the policy assessment. Chelsea Matthews will present a case study, this case on JBS. And Tom Picken will be presenting regulatory developments and voluntary initiative developments in the finance space. And we'll wrap up with a Q&A session. You can use the Q&A box to ask questions during the presentations, and at the end we'll be answering your questions. And if there's no time, we will follow up afterwards, after the webinar, to answer your questions. Just a brief presentation about Forest and Finance and who we are. We are an initiative of a coalition of campaign and research organizations, and collectively we seek to prevent financial institutions from facilitating environmental and social abuses, which unfortunately are still very common in the forest risk sector. We seek to achieve this through improved financial sector transparency, policy systems, and regulations. This is very urgent because biodiversity is collapsing, and financial institutions keep pouring billions of US dollars into forest risk commodity companies. Some research from the last years shows just how urgent this is. A report by IPBES found that there's an unprecedented decline in nature, with 1 million species at risk of imminent extinction. Since the Paris Agreement, we have lost 13 million hectares of primary forest, and agriculture is globally the largest driver of deforestation. Indigenous people represent only 6.2% of the world's population, but they protect 80% of the world's biodiversity. However, they suffer many threats to their territories, to their cultures, and their lives, because they protect these territories, which are so important for all of us. Between 2012 and 2022, almost 2,000 land environmental defenders were murdered, and many of them were indigenous people. This is why we need strong voluntary and regulatory standards to avert the worst risks to biodiversity on which we all depend. Here's a quick overview of our key demands. We want financial regulators and financial institutions to implement policies that will halt and reverse biodiversity loss, that respect and prioritize the rights of indigenous peoples, of women and local communities, that foster a just transition, that ensure economic integrity, and that align their institutional objectives across sectors, across issues, and across instruments. I would now like to pass it on to Bart Warmerdam from Profundo, who will be presenting key findings of our financial flow assessment from the Banking on Biodiversity Collapse report. Bart, thank you.
Thank you, Merel. Can you all see my screen? Thumbs up if you can see it. Yes.
Yes.
So thank you, Merel. I'll present on the financial research that we've conducted for Forest and Finance. Before I show you the findings, I will explain the research methodology for the financial research. How we selected the companies. We selected companies engaged in 6 deforestation risk sectors, so beef, soy, palm oil, pulp and paper, rubber, and timber, in 3 forest-rich regions, which is Southeast Asia, Latin America, or South America, and Central and West Africa. Companies were selected due to the size of their concessions for palm oil, pulp and paper, rubber, and timber companies, for their land areas, for soy companies, and their slaughtering capacity for beef companies. So we have around 300 odd companies in the selection of companies that we research. We research financial flows to these companies using a number of methods. We start by using Refinitiv and Bloomberg, 2 financial databases. which help us to identify syndicated financing, so where more than one financial institution participates in providing a loan or an issuance underwriting service to a company. But they also help us to identify bond holdings and shareholdings. Then we also, the next phase of the research is to look in annual reports, annual reports for listed companies, which often contain details on bilateral financing, so the gap that is being filled from this financial databases, which only contain syndicated financing. We also look at company registries, media archives. We look at specific project financing database called IJ Global, a trade financing database called Trade Finance Analytics. We also look at government sources of data, for example, the BNDES data and other sources. As I said, there are some limitations to these data sources. That's why we fill the gaps. So we fill with Refinitiv and Bloomberg, we capture syndicated financing, which we then fill or try to fill as much as possible with information from company registries and company publications. However, if the information has not been made public or is not registered in the company registries, for example, then we will not be able to find this information. So for some countries, there's more gaps than others, for example. So in Malaysia, Singapore, and also in India, the company registries are a very useful source of information, but in Hong Kong, they're not. And for listed companies in Indonesia, it's a very useful source of information. The annual reports are a useful source of information, but for listed companies in Brazil, for example, they're less useful. So we find fewer bilateral financing there. So there's some gaps in the data. The next part is we calculate. We have some calculated elements in the data set. So we have deal contributions. So when you see a deal in a financial database, you often find the participants. There will be 5 banks, but you don't see, they won't record specifically how much each financial institution has contributed to the deal. So we calculate that based on the role of the financial institution. Are they a book runner? So one of the more important financial institutions participating in the syndicate or not? And what type of financing. So for loans, we attribute a higher ratio and to the more important financial institutions than we do for underwriting. But the details of this complicated methodology are on the website. The other thing we do is we calculate segment adjusters. A lot of companies in our selection are active in multiple sectors. Some of them are also active in multiple of the 6 commodities that we're researching. So there's often palm oil companies that are also producing timber, rubber, pulp and paper companies that are producing timber. There's also companies with activities where some of the activities are not included in the scope of our research. So for example, a farm in Brazil will have soy, but will also have maize or other activities. So we calculate what proportion of their business activities we can reasonably attribute to one of the 6 commodities that we're researching, or the multitude of them. We do that by looking at annual reports, looking at their segment capex, so what they're spending their money on. If that information is not available, we look at segment assets, so what they've spent their money on in the past. And if that information is not available, we look at segment revenue. That's an ideal scenario that we can use all 3, one of those 3. Sometimes there's more informed estimated guesses, but details of the segment adjusters can be found on the website. And for each entry, we've explained the methodology and the source we've used. Similar to segment adjusters, we also calculate geographic adjusters. So what proportion of this company's business activities can reasonably be attributed to a specific country, which is in the scope of our research. So to Indonesia or Brazil, or Bolivia, or Cameroon. Any of the countries that we're researching. And we do that using a similar methodology as we do for our segment adjusters. So after a long story about the methodology, hopefully you're interested in seeing the results. So what we found is that creditors have provided around $307 billion in loans and underwriting services to companies engaged in these forest-rich risk sectors in 3 forest-rich regions in the period 2016 to 2023. Looking at the chart, the sort of an annual breakdown, you see it's relatively stable with a bit of a dip in Corona year 2020. And please bear in mind that the figures for 2023 are not complete. They're up to September 2023 and don't include annual reports data for 2023, as the annual reports only published in 2024. See, around a quarter of the financing is going to beef, another quarter is to pulp and paper, around 20% to palm oil and soy, respectively. Looking at the regional breakdown, we see around 64% of the financial flows of this credit flows are going to Latin America, about 34% to Southeast Asia, about 2% to Central and West Africa. And looking at the regional breakdown more specifically, also by type of commodity, you see that there's a large proportion of the financing going to South America is going to beef and pulp and paper, and also to soy, and for Southeast Asia, palm oil and pulp and paper dominate more. Looking at the regions where these creditors come from, you see that the majority of credit in Brazil is coming from South America. Most of that is actually also Brazil. And Indonesia is the second largest creditor. Also Southeast Asian financial institutions that are financing there. And China is a big financier, financing Southeast Asia and South America and Central and West Africa. In terms of the individual financial institutions that rank the highest, Banco do Brasil, Bradesco, and Rabobank, the first two from Brazil and the latter from the Netherlands. If we look at the creditor data, we see around $38 billion are held in forest risk investments, and forest risk investments in bonds and shares. About half of that is in palm oil, just over a quarter is in pulp and paper. And the other commodities are slightly smaller. This is mostly because a lot of the palm oil companies in Southeast Asia are listed on the stock exchange, and a lot of the other companies active in other sectors aren't so large and not so many that are listed on the stock exchange. Around 60% of the investments are in Southeast Asia and 40% are in South America. Around 55% are in palm oil. I already mentioned that. And looking at the regions where the financial institutions, the countries where the financial institutions come from that are making those investments, the US is the largest investor. It's also the country with the largest asset managers globally. They're investing in South America and Southeast Asia, and Malaysian investors are second largest investors, investing primarily in Southeast Asia, mostly in their own stock listed palm oil and rubber, pulp and paper companies. Looking at individual financial institutions, this sort of reflects that trend. These Malaysian financial institutions, these Malaysian investors, government-linked investors, are the largest investors, followed by the large US asset managers. I don't think we have time for the Latin American findings, so I'll hand over to the next speaker.
Right. Thank you, Art. That will be me, the next speaker. I'm trying to guide you through our policy assessments, which are informed in the first place by the financial research, because we focus on the 102 most important banks and investors financing forest risk commodities. So the 102 are selected based on the data which Bart just presented. We look at which banks and investors are most important in financing the 6 different forest risk commodity sectors. And then we analyze the policies of these banks and investors, which are relevant for deforestation. This is based on an assessment methodology based on international standards. And banks and investors are given the opportunity to comment on their scores, and sometimes that is the starting point of an interesting dialogue where they want to understand better why their policies are not meeting our criteria and what they can improve. The financial institutions, the 102, as I mentioned, are spread across Asia, Europe, North America, Latin America, and other regions. Like this, mostly from Asia, a quarter from North America, 16% from Europe, and 17% from South America, and some other regions as well. So these are collectively the ones responsible for a major share of all the loans and underwriting and investments in bonds and shares of companies active, the 300 companies Ward mentioned, active across the 3 tropical forest regions. And well, you might expect these banks and investors to have good policies trying to avoid deforestation, trying to avoid the issues which Meryl indicated earlier, the problems created for indigenous communities and other local communities, and so forth. So our methodology has 38 criteria, which are derived as much as possible from international standards. These are criteria on issues related to nature and environment, to climate, to community rights, but also labor rights of the people working on plantations and so forth, on transparency, on legality, on corruption, accountability. So it's really a broad mix of criteria, which are all in one way or another linked to the sectors active in forest risk commodities. These criteria are derived from international standards, from the United Nations, or but also from bodies like the ILO, the FAO, the Biodiversity Conference, and the OECD, and also from multi-stakeholder initiatives like FSC, RSPO, and RTRS. Based on these criteria, we have developed our methodology, and we grouped the 38 criteria in 3 main groups following the practice in the financial sector: environmental, social, and governance criteria, whereby the governance criteria are actually divided in 2 groups further. We have criteria which are about the governance of the financial institutions themselves, their own transparency, their measurement of their climate footprint, and so forth. But also criteria on the governance of the companies they are financing, which, for instance, deal with legality and with corruption and so forth. So we have these 3 groups. We have separate scores for these 3 groups, but I won't show you all of that. You can find that on the website. For each of the criteria, we have developed a scoring table, a scale of 0 to 10, whereby 0 obviously is that the criteria we are looking for is not included in the policy anywhere of the financial institution, and 10 points is when the financial institution commits very clearly to the criteria, formulates all necessary requirements, and also applies it to its clients or investees and their suppliers. So not only the companies directly financed by the financial institution, but also the supply chain of these companies, which is for some of the criteria related to deforestation, but also labor criteria, very important that the financial institutions apply these criteria not only to the companies they are directly dealing with, but also to their supply chains. Between the 0 and 10 points, we have 3 steps. So we have 3 points, 5 points, 7 points. So all these 5 steps, 0, 3, 5, 7, and 10, are defined for each criteria. And as good as possible, we try to match what financial institutions write in their policies with these different steps. Of course, policies is used here in a broader sense. So we look at annual reports of companies, sustainability reports, documents which carry the title policy, like human rights policy or climate change policy, but also reports on their voting behavior when they are investors, or engagement reports. So anything which has any relevance for how they deal with the companies they are financing. These total points for the 38 criteria are then converted into a score on a scale of 0 to 100%, or on a scale of 0 to 10. In the report, it is in percentage. In the website, it is a 10-point scale. And we assess all these policies separately for each of the 6 deforestation risk commodities. So especially because in the policies of financial institutions, they might say, well, we require the companies in the palm oil sector to follow RSPO. Well, then that gives them some points for several criteria, but obviously only for palm oil, and their financing in B for pulp and paper is not covered by that. So we try to assess how they deal with each of these sectors separately. So you have 38 criteria, we assess them for all the 6 commodities. But we also assess separately for financing, loans and credits, and investments. Some of the investors, like pension funds, are only active in investing in bonds and shares. But others are asset managers, which are owned by a big banking group. So then you see that the financial institution as a whole is also active in loans and credits and also in investments. And often they have different policies for these different type of activities, so we assess them separately. So that gives you a quite complex number of assessments, 2 different types of financing or investments, 6 different types of commodities, and 38 criteria. But we bring that all together in one overall score per financier, per financial institutions. And we use the amounts of financing and investments per commodity as found in our database, the figures just presented by Bart. We use them as weighting factors. So we think when a financial institution has invested relatively much in palm oil, and not so much in other of these forest risk commodities, then their policy with regard to palm oil should be leading in the total overall score of this financial institution. Well, this explains again the methodology. Most of the time we'll go into the methodology, and then now we will have the results. Well, this is from the report on the banks, so the creditors. This is on loans and credits. Some of these banks also have investment activities, but then they have a separate score for that. The bank, well, as you see, none of them, hardly any one of them is above 50%. The overall policy scores for these top 30 financiers is 24% on a scale of between 0 and 100%. And the highest scores among the top 30 are CIMB from Malaysia, which is, of course, a bit of a surprise, as in previous year, mostly the European banks were having the highest scores, followed by BNP Paribas, indeed, from Europe, and Rabobank from the Netherlands. So even the highest scoring banks are still below the 50%, so there's a lot to improve for them to reach closer to 100% in their policies. And the lowest scores among the top 30 are banks from Brazil, Banco da Amazonia, and from China, and another one from China. So these 3 banks hardly have any policy on any of the criteria we have investigated. Then looking at the investors, similar graph, this time focusing on the financial institutions investing in shares and bonds issued by the forest risk companies we have been researching. And again, hardly anyone is crossing the 50% mark, and the average even for these 30 largest forest risk investors is even lower. It was 24 for the banks, 24%, and for the investors, the top 30, it's only 50% the average. So very poor policies for many of them. There are a few exceptions which have some somewhat reasonable policies, of which the best one is Government Pension Fund Global, the big government-owned pension fund in Norway, which has a score of 56%. The Employees Provident Fund in Malaysia, again Malaysia, which is also a state-controlled pension fund in Malaysia, and the BNDES, the state-controlled development bank in Brazil. These have the best scores among the top 30 investors. And well, I won't mention all the ones who have a poor or very low score, but I just focus on the top 3 American asset managers and see their scores are also very poor. BlackRock only has 9%, Vanguard 2%, and State Street a little bit better, 16%. So for these big asset managers who manage assets for pension funds and investors from all over the world, yeah, there's a lot to be improved when it comes to their policies regarding deforestation, human rights, labor rights, etc. All the criteria we have researched. Well, this was the overview. I hope it was clear, and please raise questions if it wasn't. And thank you for your attention. I'll hand over now to the next speaker.
Hi, everyone. That's me. My name's Chelsea Matthews, and I'm a senior campaigner with Friends of the Earth. Let me just share my screen for you. So yeah, I'm going to be talking to you today about a case study to exemplify how this financing impacts the world on the ground and the front lines of deforestation. And I'm here to tell you a little bit about JBS, who you might be familiar with. They are the largest animal protein company in the world, and they have a long history of documented harmful and sometimes illegal business practices, which have been exposed by the nonprofit and civil society community, as well as journalists for over 15 years. Some of these behaviors and practices include bribery, corruption, price fixing, of course, deforestation, forced labor and other labor abuses, land grabbing and stealing indigenous people's territory, and excessive greenhouse gas emissions. In particular, when you think about JBS, people often think about the Brazilian Amazon. They're one of the largest Amazon deforesters. So they play a really major role in the climate and biodiversity crisis because of this. Between 2008 and 2020, JBS had an estimated deforestation footprint of 200,000 hectares in its direct supply chain and 1.5 million hectares in its indirect supply chain. Various organizations I've mentioned, groups like Greenpeace, Reporter Brazil, Global Witness, Amnesty International have documented cases of large-scale deforestation and human rights abuses linked to JBS between 2009 and 2022. So it's an ongoing behavior by this company. What's interesting to note is following a landmark report and campaign in 2009 by Greenpeace, JBS signed agreements with the Brazilian public prosecutor and Greenpeace to clean up its supply chain. That agreement requires JBS to ensure its products are free from deforestation after October 2009, and also free from the use of forced labor or the invasion of indigenous lands. A critical element of these agreements was the implementation of a transparent traceability system to enable monitoring and verification across its full supply chain. Yet 14 years on, despite JBS making claims to have eliminated deforestation and forced labor, as I've explained, the company is still not delivering on these critical commitments. So most recently, investigations and official audits have found large-scale deforestation in 2019, 2020, 2022, which contradict these claims by the company that it's met its deforestation commitments. And just as an example, in the Amazon state of Pará, JBS's cattle purchases of more than 1 in 6 cows were found to be non-compliant with this policy. So it's around 94,000 cattle. So, and Other interesting piece to note, there are other companies operating in this region, but JBS was responsible for almost 69% of irregular cattle purchases. So it has a huge footprint. This pattern of unacceptable business practices should really raise alarm among banks and investors. Another thing to note about JBS in the finance world is indications of greenwashing. So JBS has pledged to achieve net zero emissions by 2040. But independent research has found that JBS lacks any credible decarbonization plan. In fact, last year, the US National Advertising Division recommended that the JBS USA Holdings, the USA subsidiary, can discontinue its net zero claims because they were in fact misleading. Recent analysis also estimates that JBS has increased its greenhouse gas emissions by 51% in 5 years, which is quite significant. And estimate of JBS's methane emissions also far outpace all other livestock companies, setting them apart from their peers again. So despite the allegations of greenwashing in 2021, JBS sold $3.2 billion worth of sustainability-linked bonds, which were linked to their net zero pledge. Yet in 2023, their bonds were oversubscribed. Notably, for recent bonds, 9 of the 11 underwriting banks, including Bank of America and Citigroup, large US banks, have net zero commitments under the Net Zero Banking Alliance, but they're actively enabling this company whose business model is really incompatible with a climate safe transition. So looking at the data from the report, here's a quick overview of the largest global creditors to JBS and its forest risk beef operations. So JBS is financed by major banks from Brazil, the US, Europe, and Japan. Its top 5 creditors are BTG Pactual, Santander, Barclays, Bradesco, and Bank of America. Since 2009, these banks have enabled JBS's unacceptable business practices by providing over $718 million in forest risk beef credit. And as of September 2023, on the investment side, investors held $667 million in bonds and shares. The largest institutional shareholders to JBS are Brazilian BNDES and BTG Pactual, with shares of $412 million. In terms of the policies of the banks and investors of JBS, here's how they stack up, how it's outlined in the report. As you can see, everyone scores quite low. There's really no policies that any of these banks have that are strong enough to avoid financing to a company like JBS. Again, this is the score from 0 to 10, as Jan Willem just explained. The bank with the highest overall score out of the JBS creditors was Barclays. So that's at 43%. However, Barclays has been exposed for its major role in enabling JBS's destructive business practices, and its beef sector score is much lower, just 2.1 out of 10. So the sector scores for beef are all abysmal, with Bradesco and BTG Pactual scoring the lowest at just 1.2 and 1.5 out of 10, respectively. So this is really indicating how the policies of these banks are not doing anything to prevent environmental harm. Many of these banks also have very weak social policies, including on requirements to ensure clients and their suppliers do not perpetuate labor abuses or violate free, prior, and informed consent for Indigenous peoples or local communities. So these weak policies by JBS's main financiers enable JBS to continue these terrible practices with impunity And what we need is that banks to really be adopting, disclosing, and consistently implementing a process to end relationships with clients such as JBS, clients that continue to be complicit in deforestation and human rights abuses. So the last thing I want to say about JBS, just because this is sort of what's happening currently with the company and has been in the news on and off in the last, I'd say, 6 to 9 months. But in July of last year, JBS renewed its decade-long attempt to list on the New York Stock Exchange. So it would be a dual listing. They're currently listed in Sao Paulo. So if this listing is able to proceed, it's going to open up major opportunities for JBS to attract further investment, in particular with a more international investor audience. CSOs and global NGOs have alerted investors to the risks related to this dual listing, and several groups, including Rainforest Action Network and a number of indigenous associations in Brazil, have petitioned the SEC to investigate. What is worth noting and why, not only are these business practices that have been documented over many, many years a concern and risk to investors, but also what's really interesting is that the current listing attempt could consolidate the Batista control over the company through a major restructure that would essentially increase the family's voting power from 48.8% to 85%, which is pretty huge. And what's even more interesting is to note that the previous listing attempt that happened a number of years ago was thwarted in 2017 when the Batista brothers were embroiled in a major corruption scandal, which resulted in a $3.2 billion fine and their admission of bribing thousands of politicians. So there's a very clear and long history to this company. It should be very clear to investors that this is a company that's risky and just not worth being on this global stock exchange. So that was just my quick highlights about JBS to kind of show you all how this financing looks on the ground with a real case of a real company. And I'll pass it now to Tom Picken, who's going to talk about regulatory updates.
Thanks, Chelsea. Hello, everyone. My name is Tom Picken. I'm with Rainforest Action Network. I'm the campaign director for our Forests and Finance campaign. So I'm going to spend just a little bit of time running through some regulatory developments that are relevant to the financial sector's role in the biodiversity crisis. And I think it's worth starting by noting that the data and policy assessments that we've just seen here, as well as an example of the continued operation of some large clients that are in receipt of large-scale finance, it's clear that the industry's responses to the biodiversity crisis are largely inadequate. We have seen some policy improvements in some banks in some countries, but they don't go far enough, and there's huge concerns around the implementation and compliance of those policies in any case. So what we're seeing is the continuation of billions of dollars going into forest risk commodities that continues to drive deforestation and rights violations. The need for robust state action and multilateral action is very clear. Governments must change the financial sector rules to ensure that the industry puts in place the policies and operational standards for addressing the biodiversity crisis. Very notable at the end of 2022, with the signing of the Global Biodiversity Framework, we've seen a really significant development in that Target 14 makes a very clear requirement on states to implement policies and regulations across all levels of government and across all sectors, with a particular reference to the financial sector, both public and private. Here we're seeing attempts at looking at what states must do to really start to reshape the real world economy. Against this backdrop, we are also seeing the body of evidence growing for why and how this change must happen. Some really interesting research was published by the Network for Greening the Financial System, Inspire Group, in conjunction with the Grantham Institute. And this presents an assessment of the regulatory developments that we're starting to see, and also offers recommendations on scaling up those efforts and implementing new tools at the disposal of governments that will be needed to genuinely shift finance out of biodiversity collapse and into biodiversity protection. The basis of the NGFS Inspire Group really is that central banks and financial regulators have the mandate to take action, and they ultimately have a responsibility in terms of ensuring financial stability. The report presents a number of central bank and supervisory options and illustrates where some of those developments are already taking place across the globe. The different categories of developments that we're seeing and need to happen include and range from the research, assessment, and policy signals, contributing to the financial architecture itself through things like taxonomies, prudential policies and instruments, financial market conduct. And in particular here, it's notable that there is a strong focus on needing to ensure that greenwashing and financial crime is addressed, macroeconomic analysis and monetary policy, and central bank non-monetary policy portfolios, and action to get policy coherence, so policy liaison and coordination between instruments and initiatives. In the Banking on Biodiversity Collapse report, we present a few notable developments across the world. On this slide, there's a collection of what's happening within the producer financial sector countries. As we saw from the data presented earlier, Brazil, Indonesia, and Malaysia feature very prominently with very significant financial flows into their own domestic industries. In Brazil, there's a framework for sustainable sovereign bonds now, which excludes industrial livestock activities. And this is a really important development and acknowledgement of the role of the industrial livestock sector in contributing to biodiversity collapse and climate crisis. There's been an announcement for the incorporation of the IFRS sustainability disclosure standards into the regulatory framework, and an action plan for the development of a sustainable finance taxonomy. In Indonesia, in addition to the development of the taxonomy there, recently there was the P2SK law, which has served to strengthen the financial, which served to strengthen the legal status of sustainable finance, and has created opportunities and higher standing of that regulation to harmonize policies and regulations. Within Malaysia, we've seen quite a lot of movement and a lot of action by the central bank there. And of note, there's an update to the climate change and principle-based taxonomy, which will facilitate the standardized minimum due diligence standards. Some other developments in the US and European Union and internationally, things are happening somewhat more slowly in the US. We've seen California introduce 2 climate disclosure laws. New York has adopted the Tropical Deforestation Free Procurement Act. In the European Union, the major development with the EU deforestation regulation entering into force, though it must be noted that the financial sector itself successfully lobbied to be excluded from that. And it's really imperative that the EU undertakes a review to bring the financial sector within the scope of that regulation. And there is an opportunity coming up next year to be able to do that. Also worth noting, the Task Force on Nature-Related Financial Disclosure launched in September last year. This was an industry-led initiative developed by 40 corporations, and it was largely modeled on the Task Force for Climate-Related Financial Disclosure. research suggests that model has not been effective in reorientating financial flows. And there's a lot of concern across the civil society space around the flaws in the TNFD to be able to do the same thing. In particular, the TNFD does not align with the global biodiversity framework, and it does not require double materiality, which is looking at both the impacts of the financial sector as well as the resulting impacts on the business to nature decline. Coming back to the NGFS Inspire recommendations, really critical here that to ensure alignment with the Paris Agreement and the Global Biodiversity Framework, we really must see this rapid implementation of outcome-orientated policies led by central banks and financial sector regulators. Of particular note is recommendation 5, which is building the necessary financial architecture for mobilizing investment for a biodiversity positive economy, and including by considering how central banks' own operations should be conducted in the context of biodiversity loss. Again, coming back to things like taxonomies, ESG standards, minimum due diligence, and looking at biodiversity-related considerations in monetary policy and incorporating biodiversity protection into central bank investment portfolios. So these are some of the tools that we really need to see rapid developments in for states to be able to fulfill their obligations to the global biodiversity framework and set the kind of architecture that we need for the private sector to change course. Just going to finish with this quote here from Ravi Menon, who's the managing director of the Monetary Authority in Singapore, who's also actually the chair of the NGFS Inspire group. And it really makes this point clearer that we have an imperative to reshape and retool the financial sector, and that must start with governments. Thank you, and back to you, Meryl.
Thank you so much, Tom, and our previous speakers, Chelsea, Jan-Willem, and Bart. We will now open the session for questions. We already have one question from Danielle. I'm wondering maybe, Bart, you can answer this one. The question is, Rabobank is in the top 5 of financing forest risk companies, but when looking at the data, this is mainly for a few years ago, and their financing has decreased a lot. Do you have an explanation for that? And a second question is, in general, is the trend of deforestation financiers' home countries showing a shift from Europe to other regions?
Yes, thanks for the interesting question. Yes, we do see a shift in which financial institutions are providing more credit, indeed, to forest risk companies. A shift from European players more to more regional and local players, partly as the regional and local players are more and more active in financial markets, helping with issuance underwriting services and the like, and participating in large syndicated financing. And some large European financial institutions withdrawing, for example, from trade finance, like ABN AMRO and BNP Paribas have done. On Rabobank's reduction in financing, it may be related to the policy, so maybe Jan-Willem can speak more to that point. For example, Rabobank's financing of JBS, we've seen recently that it's not been financing JBS as a group, but it has continued financing JBS's operations in the US.
Jan-Willem, would you like to comment on the policies?
Yes, but it's also speculation, of course. But it is, of course, what you hope to see, that better policies lead to more critical due diligence and critical assessment of the companies they are financing. So, but we have not looked into that very deeply, and it's also quite difficult, and that's always a bit the difficulty with this type of questions. I mean, you hope when you convince financial institutions to adopt better, stricter policy that it also has its impact on which companies they're financing. But they hardly ever will tell you, well, we stopped financing this and this company because of our policy. That's something they usually don't explain. So yeah, it's a bit speculative what exactly is behind that.
Thanks, Martin and Willem. There was also a comment in the chat about other forest risk commodities like avocados, for example, becoming increasingly an important forest risk commodity. Maybe would you be able to comment on why we selected these 6 commodities that we focus on and if there are plans to add more commodities? Maybe Ward?
Yes, thanks for the question. I knew avocado was like had an impact on water resources, but so for the 6 forest risk commodities we selected, we identified them a number of years ago as the main drivers of tropical deforestation. There are, of course, other sectors, coffee, cocoa, for example, that would be relevant sectors. But for the 6 that we've taken in the selection, it was drivers of tropical deforestation, but also linked to large companies or linked to companies that we could research. If you look at cocoa, the nature of that is many more smallholders. So it's not many companies so much on the upstream as you have with, for example, palm oil and pulp and paper. And yes, we do have the ambition of expanding to additional sectors, including coffee and cocoa, and maybe even avocados now, I don't know. But definitely expanding to other drivers of deforestation as they shift, and also maybe looking at mining, for example, which is also increasingly a driver of tropical deforestation as we are moving in the energy transition with nickel exploitation in Indonesia and the Philippines, for example, lithium in Chile and Argentina, and there's many other issues to look at.
Thank you, Ward. There's another comment in the chat about how climate policy might actually be driving the expansion of the production of forest risk commodities, with an example of California Phillips 66, which is earning low carbon fuel standards credits from making liquid biofuel, which is made from soy and imported from Argentina. Wondering, Tom, would you maybe be able to comment on what more policy development we need to avoid this well-intentioned climate policy from actually causing more forest deforestation and rights violations, and how financial regulation can contribute to that?
Yeah, I think perhaps our colleague Chelsea from Friends of the Earth might have more to say on that specific example raised around the California climate policy incentives. But indeed, this is a continuing to, it's a growing problem in a number of places, including the increase in supply chain of woody biomass and other biomass from Southeast Asia, Indonesia in particular, to Japan, for example, as we see climate policy expanding. It's been a feature and a major concern within the European renewable transport fuel policy space as well. I think there is some scope of ensuring that as taxonomies are developed, we ensure that there's a do no harm principle that underlies those taxonomies and classifications of sustainable finance. So, for example, we would need to see coherence across a number of categories, including both climate and biodiversity policy, instead of narrow definitions of looking at transition energy, for example, and excluding those wider knock-on impacts on land use and rights where that's an issue. Thanks.
Thanks, Tom. We have another question from Hansai, I hope I'm pronouncing that correctly, who's asking clarification on the methodology. And the question is whether, when we looked at the financial ties for forest risk commodities, if we assessed financial flows to all the 6 commodities that are in our database, or if we filtered them only for investments or credits that are actually known to be exposed to deforestation. Maybe, Ward, would you be best placed to respond to that?
Yeah, lots of questions. We selected the companies for their activities, not so for their activities in specific sectors, not for their not for deforestation specifically. So that's why we call them forest risk companies or forest risk sectors. And there's beyond deforestation, there's many other risks that companies operating in these sectors are exposed to: land grabbing, labor rights issues, many other things. So yeah, we have on the website, if you go to the profile of a financial institution, you can see which of the companies are exposed to a forest sector risk by looking at the little red dot next to it. There's a risk flag. We got these flags by looking at ZSL Spot and chain reaction research and other NGO research about whether or not these companies are involved in environmental, social, and governance allegations where there's allegations against them. So, and long story short, companies are selected for their sector activities, not for deforestation specifically.
Thank you, Art. We don't have any more questions in our Q&A box. I'll just open for one last round. If there's anyone else who would like to ask a question. If not, I would really like to thank all our participants today and all our presenters, Chelsea, Wart, Jan-Willem, and Tom. Thank you for presenting. We will be sharing the link of this presentation with you in a follow-up email. It will also be available on our YouTube channel. And of course, you can read the whole report, which Rebecca just kindly shared in the chat with all the data that was presented today, our Banking on Biodiversity Collapse report. So thank you all and hope to see you in next webinars.